welcome to our monthly webinar. Today's topic is Women, Wealth, and Legacy, Why Estate Planning Looks Different. And we'll get started in a few seconds, just waiting for a few more people to log in here. So just hang tight for a few seconds. Okay, let's get started. So good morning, everyone, and welcome to our monthly webinar. Today's topic is Women, Wealth, and Legacy, Why Estate Planning Looks Different. My name is Sue Talbot. I'm a partner and portfolio manager at Genus, and I'll be moderating today's session. I'm also very pleased to be joined by three wonderful professionals, each bringing a different perspective to today's conversation. So we have our very own Tiffany Lusher, who will provide the portfolio manager perspective, and Rose Shawley, who will share the legal perspective, and Nicole Karubi, the accounting perspective. I'll be inviting each of them to introduce themselves shortly. But in the meantime, we're going to add our links to our profiles on LinkedIn in the chat, and would love for you to connect with us. So while we're waiting for a few more people to log in, let's get our housekeeping items out of the way. So please maximize your screen to get the best viewing experience. I think there's arrows on the top right to do that. We'll also have a Q&A session after our discussion as well. So please feel free to drop your questions into the chat and we'll get them answered for you. And if you're having technical trouble, you can let us know through the chat as well. We do have somebody on hand to assist. And if you're having audio or visual problems, the best solution is hopping on and hopping off and then back on. And that usually solves the issue for us. So I'd like to start by extending my gratitude to the Indigenous people, specifically the Coast Salish, Tsleil-Waututh, Squamish, and Musqueam, whose lands we're honored to speak to you today. As we talk today about women, wealth, and legacy, it is meaningful to recognize that in many Indigenous cultures, women have long played vital roles as leaders, knowledge keepers, and stewards of community and family. We share this knowledge as a small step toward greater respect, understanding, and reconciliation. So let's get started. I'll turn it over to our panelists for a quick introduction, and we can go in order of the slide here. So we'll start with you first, Tiffany, and then Rose, and then Nicole.
Thanks, Sue. Good day, everyone. My name is Tiffany. As Sue mentioned, I am a portfolio manager and partner here at Genus. I have been in the financial industry for 25 years.
I'm Rose Shawley, and it's an incredibly tough act to follow Sue and Tiffany. So basically what I do is death and taxes from the legal perspective. And I do it over here at Boughton Law, and we look at it in the holistic context of succession planning for individuals, businesses, and families.
Hi, everyone. My name is Nicole Karubi. I'm a partner in accounting and advisory with Crowe Mackay in Kelowna, BC. Absolutely enjoy working with clients, helping them to determine their path for their estates and navigating taxes along the way.
Great. Thank you, ladies. Welcome. And I'm really looking forward to our discussion. So we'll start off with why this matters, why this topic today. Well, for me, in my conversations with clients, many of them women, I often hear that they know they need to get their affairs in order. But when it comes to estate planning, they're not always sure where to begin or what questions to ask. What's also clear is that no two situations are the same. Women are navigating very different challenges and circumstances. So for me, that's what inspired today's conversation. So we hope to bring some clarity and to show that estate planning for women needs to be more thoughtful with a tailored approach. Another thing we're seeing is a real shift in how women are engaging with wealth, whether that's taking a more active role, navigating transitions, or thinking about legacy in a different way. So when you put all of that together, we're seeing three patterns or three realities really start to emerge in the work that we do with women and families. So the first thing we're seeing is that more women are managing wealth independently. So whether that's through divorce or simply outliving a partner, many women at some point will become the primary financial decision maker. So that means estate planning really needs to be approached with that independence in mind. The second is that women's financial lives are often more complex. So things like career breaks, caregiving responsibilities, blended families, and second marriages. Even some are supporting both children and aging parents as well. So this is all going to add layers that can affect legal, tax, and investment decisions as well. And the third is that women are increasingly shaping how wealth is being used and transferred. So part of this all ties into what's often called the great wealth transfer. I'm sure we've all heard that term. So over the next couple of decades, a significant amount of wealth will move to women through inheritance or longevity. And that's going to come with a much bigger role in deciding how that wealth is invested and ultimately passed on. So when you take all of that together, it really starts to change how we think about both financial and estate planning for women. And with that in mind, we've organized today's discussion on these following five themes, and I'll briefly walk you through them. So the first is planning for financial independence. So really thinking about how financial plans support women who may be managing wealth on their own at some point. The second is when life takes a new direction. So things like divorce, widowhood, or any other major life changes that often mean financial plans need to be revisited. The third is guidance through life's transition. So as careers evolve, family dynamics shift, and responsibilities change, financial plans really need to adapt alongside that. And the fourth is women as financial decision makers. So we're seeing more and more women taking the lead in investment decisions and shaping family wealth. I personally am seeing that with my clients as well, so that's really great. And finally, designing a legacy with intention. So really thinking about how wealth is passed on in a way that reflects values, priorities, and the kind of impact we want to have. So before we jump into the discussion, we're going to run a couple of quick polls just to get a sense of who's with us and your experiences. So Graham, who's working behind the scenes with us, he's pulled up the first poll there. So the tab on the top right. So the poll question is, what financial topic do you wish someone had explained more clearly earlier in life? And the choices are investing and markets, taxes, estate planning, and all of the above. So we'll just wait for a few seconds here for people to answer. So thank you for that. No surprise, really, all of the above. I thought all of the above might win this one, but just reaffirms that more information is needed to help make some of these topics a little bit easier to understand. So thanks everyone for answering that. And Graham, the next poll, please. So the next question is, which financial topic, which financial topic do you wish someone had explained more clearly earlier in life? Oh, sorry, I'm totally confused. Okay, sorry. The question is, I'm looking at the bottom. The question is, when do you think most women become the primary decision maker for family finances? So the answers are early in their careers, when they get married or start a family, after a major life event, and they've always been the primary decision maker. So thanks everybody. And if there is a right answer, it is the third one, after major life event. The reality is that many women will become the primary financial decision maker later in life. often after a major life transition. So that's one of the reasons why planning ahead or having a clear framework can make such a difference. Okay, so let's begin our panel discussion with the first theme, planning for independence. So Nicole, the first question I have is for you. What are the immediate financial or tax shifts that occur when a spouse dies that many women don't anticipate?
I think it happens that we expect everything to kind of continue on as it always has been. And so what'll happen though is often our income changes. Obviously, you both were potentially earning income together, but the manner in which you now receive that income is all under one set of tax rates. And so we also end up seeing taxes change kind of overnight as well. And when we look at income, income can change because maybe there's a pension plan that ends when your spouse passes away, or there's substantial RIF income that your spouse was taking. Well, now it's been rolled over to you, and you're required to take a much higher minimum. And so all of a sudden, if our income increases all under one set of marginal tax rates, the overall tax that we're paying will be greater than when we were able to have both our spouses and our own marginal tax rates. And so often, the other piece of the puzzle that occurs when someone passes away is a lot of our assets have what we call deferred tax, meaning we're not paying any tax on them today, but when we pass, there will be taxes. And so we've changed the direction of how those assets or how much of those assets may be at the end of the final individual to pass. An example of that is your RIF, your RRSP. Under two persons marginal tax rates, we could draw on quite a bit over our lifetime. But under one individual, what ends up happening is we get into the high tax brackets right away. And so we may not draw quite as much as we would have otherwise, leaving behind a larger tax burden when, say, you, the surviving spouse, finally pass away. So I think understanding that there is a shift in income, there's a shift in taxes, and things do become a little bit more complex when, even though in simple form, it's now just one individual, there's greater complexity in planning for both your income today and into the future, but also for your estate and what that'll look like as well.
Thank you. Those are really great points. So Rose, the next question is for you. When planning for a point where you may be the sole decision maker, what legal structures are most often overlooked?
Frankly, all of them. And I think it comes back to exactly what you said earlier, in that there's this hesitation of asking questions because we just don't know where to start. And sometimes it's because it's all new. Sometimes it's because things change so quickly that we thought we had a handle on it. And now it seems like there's a barrage of information and none of it's really centralized or consistent. So I think that when people are approaching the planning, the first thing we want to do is give ourselves a little bit of grace. Anything you ask is fine, and anywhere you start is fine. And the tools that are right for each individual will change dramatically on their circumstances. And I think that sometimes we feel this sense of communal pressure that my friends or my colleagues or my siblings, they've done plan X. Well, I can now just repeat that, or I really don't need to think about it. This is what works for everybody. And then they get the information that may just not work for their circumstances. And it's a bit of a curveball. So I would say that yes, most people need a will, which tends to manage the distribution of the bulk of our assets when we pass. And almost everybody needs a power of attorney, which in BC is the document that appoints someone to handle our financial affairs and our assets if we become incapable. And most people need a representation agreement, which is the operating document to appoint a healthcare decision maker. But there's also tools out there like trusts and creative ways to use joint assets and trusts attached to various beneficiary designations like life insurance, and RIFs. So there's a bit of a hodgepodge out there that's available. And I think the big thing is to be patient with yourself and have a really transparent conversation with whoever's handling your estate planning. And I don't intentionally use the word lawyer there, because in a perfect world, your estate planning is a collaborative task. We're sitting down with your financial advisor, with your accountant, so that everybody's got the same information and you've got an entire team there to support you.
Great, thank you for that. So it's really about being prepared and I guess having options when things change. So we'll go on to theme number 2, when life takes a new direction. And Tiffany, this one's for you. So how should financial priorities shift when she becomes both the financial planner and the family safety net?
Well, as you mentioned, Sue, there is an anticipation of a wealth transfer. The expectation is it'll be around 3.8 trillion in financial assets for Canadian women. And in a recent RBC Wealth report, only 22% of us have a plan for this transfer. So what needs to be considered is rebuilding or reviewing, reevaluating her goals, her values, her investment strategies. And some ways that can help and where we can start is you reevaluate your cash flow and your budget. And you need to plan on your legacy, preservation, and longevity. According to a survey, Canadian women on average tend to outlive men by 4.5 years. So we do need to take that into account.
Thank you. It's all about adapting when things change. So Rose, this one is for you. In blended families or second marriages, what legal protections are essential to avoid future conflict?
I love this question. And let's be transparent. We're not only dealing with second marriages, sometimes there's third, fourth, and fifth relationships. We sort of pulled the Liz Taylor way of approaching relationships, where we don't understand it's okay to date and we have to get married or couple up. I think right now, the biggest hurdle that people are facing is that the law is incredibly uncertain. And in the good old days, we used to know who our spouse was. If I got married, you were my spouse. If we lived together for 2 years in a marriage-like relationship, you were my spouse. All of those rules have disappeared, and it's now an incredibly vague framework. It's important to know that when you're dealing with your estate plan in BC, and I do want to be clear that I know nothing about other provinces. So if you happen to be joining us from somewhere like Ontario, I apologize, different landscape. I have no idea how it works there. In the framework of BC, you really have 3 parallel and converging levels in determining who your spouse is. We have our income tax system, which is really Nicole's purview, so I defer to her on that. And the rules for who our spouse is there are quite specific and more predictable, I would suggest. Then we have BC's family law system, which is a bit of an amalgam of our Family Law Act and the case law has developed, meaning the decisions that the court makes over time. Then we have our estate planning system, which is primarily driven by the Wills, Estates, and Succession Act, coupled with how courts treat it. Within that BC matrix that is specifically family law and estate planning, the definition is fundamentally, if I am married and we haven't intended to terminate our relationship, we're spouses. So an example of where we could be married but not be spouses is where, let's say for whatever reason, we separated 30 years ago, but we never divorced, we can still cease to be spouses. And that way the person I've been in a new relationship with for 20 years that I haven't married is my spouse. And it's intended to reflect that divergence in practices. But what we think of as common law is a festering cauldron of uncertainty. And I don't want to overstate it, but as you can tell, I have thoughts on this. If you are in a marriage-like relationship, this is where you walk into the estate planning situation that gives rise to 2 really important things. One is that when I pass away, if I have done a will, anybody who is my spouse has a legislated right to go to court and ask them to change my will and give them more. And we call this wills variation. The other is that if I don't have a will, if somebody can establish standing as a spouse, they have a legislated right to inherit a portion of my estate. So there's certainly some economic incentive to say that I am somebody's spouse. But what if I don't actually know that we were spouses? And where it's getting really hard for people to plan into this is that situation where we intentionally didn't live together with the idea that we were insulating our assets and our legacies for our existing families. So I was protecting these for my kids, he was protecting them for his kids, and we didn't live together because we wanted it to be really clear. Well, now the courts are finding that you can still be spouses in that circumstance. And in fact, a recent case that came out was a circumstance where individuals over a span of about a decade had repeatedly papered, both of them having had independent legal advice, that they were not spouses. And then the court said, oh, guess what? You're spouses. That is a terrifying matrix in which to try and create certainty. So, when we're dealing with blended families, as weird as it sounds, one of the first things to consider is, do you know who your spouse is? And here's how you can accidentally have a spouse. Let's be mindful of how we choose our social interactions from that lens. And then we plan from all of those factors and try and create as much certainty as we possibly can.
Great, thanks, Rose. Great advice. Incredibly complex by the sounds of it. Okay, Nicole, what tax considerations tend to arise in divorce or second marriages that people may not always anticipate?
I think for divorce, ultimately, it's the concept that there's a full financial restructuring. Assets are divided in certain ways as they're agreed upon. And as we move through that process, we have to very carefully make sure we fall under the Tax Act in terms of how, say, a RIF or an RRSP is transferred, or how private and corporate shares are transferred, in order to not walk into taxes that we didn't intend to do. And so those can cause a lot of surprises. If I've had a few clients that have said, "Oh no, I've just handled the agreements ourselves. We didn't talk with anyone." Oh, okay. But you're potentially about to walk into paying taxes on a disposition of shares, for instance, that wasn't otherwise intended. So we do want to be very careful in that specific area under divorce, that we are getting the right advice up front and as soon as possible, so that we don't do something that causes a tax consequence that we're not aware of, or that we can't actually potentially pay if it was severe enough, right? The other one is under divorce. Oftentimes there are spousal support payments that begin once everything is settled. And so we have to get into this new light of where maybe our spouse was earning income as a salary and having taxes deducted up front, and they've never had to pay installments, that if we're the ones receiving the support, that we're going to have to be prepared for taxes. So I may receive $10,000 a month, but I need to actually set aside and send into CRA on a regular basis the taxes on that, so that I don't get to the end of the year and find out I have a significant tax burden. And so it's a matter of understanding under a divorce, what are the assets, what's being transferred, and who's going to be earning what income going forward, to kind of make a clear plan, and understand your cash flows and where you're going with that. When we look at second marriages, I think oftentimes, I think Rose alluded to it a bit, there's this expectation that what is mine and what is theirs, and my children will benefit from my items and my assets, and their children, if they have any, will benefit from theirs. But there is significant structuring legally and accounting wise and tax wise that we need to put into place if we really want to protect those wishes. And so in some cases, it means moving into a scenario where you have a trust that is a legal document, and Rose speaks to that better than I can, but that doesn't allow for wills variations to occur. While there potentially could be other issues, it better protects your wishes where we start to get into these blended families. And also looking at the types of assets that you hold, because many times we have a variety of assets. Some fall inside our will and some fall outside our will. And what I mean by that is if I have my family home and it's only in my name, not considering a common law issue or anything like that, it's going to be taxed under my estate. But if I have a RIF that has a beneficiary outside of my estate, so meaning my beneficiary is not my estate, but rather my child, that RIF is going to go immediately to my child. And so if that's not what is intended, and we've moved into this scenario of having a second marriage or a new spouse, we have to be very careful that what we are documenting and intending to do are the same, so that we can stay consistent as assets and taxes are incurred.
Great, thank you. That's also very good advice. So we'll move to the third theme, guidance through life's transitions. And Tiffany, this one is for you. What are some of the investment decisions or challenges that commonly arise in the first 12 months after a major life transition?
So what I've seen when it comes to divorce potentially is deciding to rush to settle, to just move forward, causing women to give up on assets, which can be detrimental to their financial plan, their estate plan, retirement, all of that. Underestimating costs is another one, assuming that certain expenses will go down significantly when they might not be affected at all or only go down slightly. So being unaware of that cash flow budgeting that needs to be done, and potentially not viewing the entire picture and looking forward. Obviously, as a major life event, it's hurtful and can change and focus might not be there, but it is important to meet with your team and have those discussions. When it comes to a spouse's death, some of the things I've seen is selling major assets too soon, selling your home, moving into a condo, downsizing, and then realizing that you weren't ready for that. Also missing out on survivor benefits, such as CPP death benefits, pension benefits, potentially filing as a single person too soon, which Nicole could probably speak on. And also not updating your power of attorney, your executor in your will, or changing your beneficiaries of your RSP, RIFs, or TFSAs and leaving them as your spouse. So those are the most common ones that I've seen.
Great, thank you. This one's for Nicole. What tax issues tend to arise in the first year after a major life transition that people often aren't expecting?
Yeah, so in the first year after any transition is kind of an interesting period of time in life. Whether you're dealing with a death or a divorce, there is a lot going on and a lot of emotions, and usually a lot of learning. Where you were very involved in finances, they're still often learning because just everything's changed. And so it also can be the time when kind of our tax system catches up with you. There's a lot of filings, often elections and things that follow a divorce or a death. And so wanting to be on top of those so they're not missed and don't end up causing any additional tax consequences you hadn't otherwise expected. On death, there might not be any immediate taxes where all of the assets are transferring to you as the spouse. And I speak to taxes and not probate here, so probate fees are separate, but in BC at least. So for taxes, oftentimes we have this opportunity among spouses to roll over the assets and not incur the income on the departing spouse's tax return on their final tax return after death. So there's a little bit of that kind of immediate tax planning and getting in front of what is intended and planned to do, and understanding if wishes are different than just the simple it goes from one spouse to another, that there could be tax consequences that you may not be aware of, and making sure you're talking with an advisor before making those bequests is key. In divorce, we often find that you know, you want to be very careful of the timing of certain elections, the timing of which, as Tiffany mentioned, the timing of which you indicate that you're actually divorced on your tax return. You might feel like you're divorced because you've said it a million times, I'm getting divorced. But we need to follow the legal and accounting and tax processes to make sure that when we start to report those things, that they are in fact occurred, so that we don't lose out on other types of benefits that we didn't intend to. Or cause an asset to, for instance, be disposed of when we didn't intend to and have taxes there. Yeah, I think, proactive planning could really change the outcome of a lot of this. So obviously, when we're dealing with death, sometimes we are aware that our spouse is sick and we want to get in front of it. Sometimes it's years we expect from now, and so we often delay it. But having the conversations early and often with each of your advisors, or at the same table as Rose mentioned earlier, is key to making sure that we don't have those surprises upon death, and that everyone is playing together and working as a team. In divorce, I think ultimately proactive planning is immediately as you begin that transition. Sometimes it's yourself that's making the decision to separate, and at other times you are not aware that it's going to happen. But if it does occur, is getting in front of your team once again and starting to talk through and not missing out on opportunities.
Yeah, it sounds like the first 12 months, there's a lot to navigate, and it's not always obvious what needs attention right away and what can wait. So having guidance through this period is really important. Okay, so let's move on to the fourth theme, women as wealth decision makers. So Rose, this one is for you. When women take a more active role in directing family wealth, do you see changes in how legal structures are designed, such as trusts, governance, or philanthropy?
Absolutely. I find that most women with whom I have the pleasure of working really have a clear vision of what they want the outcome to be. And it may take a while to pinpoint exactly what the nuances of that are, but there's generally a very strong sense of direction. And I think that that's something that our male counterparts don't always have. Sometimes they're more mechanically focused. I want to save tax, as opposed to, I want to have these assets available for this person for this purpose. And when you're designing with that level of intention, it allows you to create tools and structures that are much more specific and create that specific result. And the counterpoint to that is, well, I want to save tax. Who doesn't? I salute that effort. We can always do something that saves tax, but it might not work on the ground. It may not be a structure that has a level of simplicity or complexity that matches the people you're appointing to control it. It may be something where you want to save all this tax, but you don't disclose enough information, and now you've appointed someone who's got US tax status or is not a resident of Canada, both of which have a huge impact on the functionality of a plan. And so I think women really, I don't want to give ourselves too much of a pat on the back, but I think we really are very smart about approaching it from the outcome perspective, because from there we can reverse engineer. And that outcome changes when there are major life events. It could be because I've started a business and I want to make sure there's continuity for my employees. It could be that I've had a death in the family and I've got a different level of inheritance I want to see passed to different people. It could be that I've had a child who's had an injury and is now receiving some kind of disability benefits, and we want to preserve them or make sure they've got long-term continuity of care. There's all kinds of changes that can inform this, and women really do a fabulous job of approaching their planning from what they want that outcome to be.
Great, thank you. Next question is for Tiffany. When women become the primary decision maker for family wealth, do you notice differences in how they approach risk, time horizon, or investment priorities?
There are definitely differences, that's for sure. As women, we tend to invest less than men on an annual basis, even if we have the same income. And we also tend to invest less in equities. Sometimes that could be about a lack of confidence in understanding where the money's going, or not being knowledgeable enough, or feeling like you're not knowledgeable enough in investments. And some of this can end up, if you don't know where to start, you end up in that freeze zone, and then you don't get started. And so it's really, as Rose had mentioned earlier, it's just taking that first step. As women, we need to consider a long time horizon. As I mentioned earlier, we tend to outlive men, 4.5 years. But also women, we tend to invest values-based as well. We might not necessarily look at return first or taxes. We look at what is the good that this money is going to do, not just for myself, but for others.
Great, thank you. So I think what stands out that when women are leading the decisions, the focus often shifts. So it's more towards, it's not just all about the numbers, more about values, priorities, and the bigger picture. Okay, so the last theme, designing a legacy with intention. So Rose, this one is for you. How do you balance fairness and family harmony in estate design?
I love this question. It is so complex because each person's family is different, but there are certain common threads that weave throughout any plan. And I think the first one is really simply to be honest about the family dynamics. And that is very much easier said than done, and I appreciate that. I think the most catastrophic plans that I see are the ones where people take the approach, my kids have never really gotten along, which usually is a euphemism for none of us have been in the same room in 25 years because we'll kill each other. But you know what? I'm going to name them all as co-executors or co-powers of attorney because that's going to be a unifying moment. Moments of stress and crisis rarely unify, rather they exacerbate things that are already cracks. And any plan that's not based on that really frank assessment of those realities usually creates more problems. When we're looking at how to create successful family harmony, I don't think there's anything wrong in recognizing that not everybody gets along. And for some reason, as women in particular, we seem to feel this burden that, well, they're our family. Oh my gosh, what has gone wrong within this environment and how was I responsible for it? But if we took away that family overlay and we gathered any random assortment of 4, 5, or 10 people, they're never all going to get along. And I think that we have to accept that that's not really any different for family. It's still just a random assortment of people who have a different potential overlay. And we then build on that. And I think sometimes the solution for a lot of people is to change the people in control from family, which we tend to think of as being that mandatory or default go-to. I'm going to make my kids my executors, or I'm going to make them my healthcare decision makers. If this is going to create problems, there's nothing that says they have to be the go-to on that. So I've got lots of colleagues who appoint more remote family, whether it's siblings, nieces, nephews. If it's not in the healthcare space, often they'll turn to professionals to do it. And I, under no circumstances, mean appoint your lawyer. My general approach is if you ever encounter a lawyer who's saying, appoint me as your executor, appoint me as your power of attorney, run, don't walk. We are not regulated for that. We are not insured for that. And I promise you, we are not worth paying our hourly rate to go manage cleaning out your fridge. For anybody who doesn't believe me, I'll send you a photo of my fridge. But there are professional, separately regulated industries for this called trust companies, and they can ensure that there's continuity there. And one of the huge values they bring to a process like this is that not only are they objectively neutral, they have the appearance of being neutral. So if I'm looking at trying to navigate a family dynamic where, let's say, 3 of my kids just do not see eye to eye, even if one of them would act fairly and objectively, doesn't mean that the other 2 will see them as doing that. And sometimes that's got as much fallout as whether there's an actual problem, because perception is very much reality in these circumstances. So be creative. There's almost always a solution.
Great, thank you. I think a lot of us, do find ourselves in this situation with family dynamics, and independent trust company is a great option for that. So Nicole, what are the most overlooked tax opportunities when designing a legacy plan?
Well, I think that ultimately, I think we alluded to it before, that our male counterparts often focus on tax. And so what causes us to overlook things often is that we start to look at legacy planning as being trying to be as tax efficient as possible. But when it's really about protecting our choices and our wishes in the future, and then understanding the impact of those choices and wishes, and finding a path that balances both where we can. And when I think of overlooked opportunities, I don't think there's one specific one that stands out to me. But when we start talking about, say, about the liquidity of an estate, then things start to stand out a lot more. And what I mean by that is that from a tax perspective, the different assets that you hold have different tax liabilities. Some of them there's no deferred taxes on, right? Your registered account, or your non-registered account, sorry, held with Tiffany maybe, is an investment account that you've already paid taxes on. And the only taxes that are going to be incurred upon your death are the taxes on the gains that haven't yet been realized, meaning you bought it for $100 and it's now worth $2,000. There's a nice big gain of $1,900. Okay, there's some tax there. But what happens is we have a mix of pool of assets that have different tax liabilities attached to them. So we have our principal residence, we might have a cottage property, we might have a registered investment fund that's paying out to us. So each of those have different tax aspects. So my personal residence, if I've lived there the entire time and I only choose it as my exempted property, I, upon death, won't have to have any taxes to my estate for that property. If I have a second property, well, now I have to make a choice as to which one I pay tax on, because I only get one exemption per year, per calendar year, that is. And so I have to be very careful to go, okay, which is the choice there, and what taxes might be incurred. And then I might have my RIF, right? And my RIF hasn't been taxed yet in my lifetime. And so upon my death, it gets taxed at full rates. So the highest rates are usually what applies if your estate is large enough. And so that could mean 53% in BC. When I look at that holistically, if I understand that I have these different assets that have different taxes, that also means I can plan for it. Meaning that when I hit that big RIF and my estate has to pay all of the taxes on that, I need to know that my estate has enough liquid assets to pay those taxes, because often times we have a defined beneficiary for that RIF. And so its cash immediately moves out to the beneficiary while the estate has to pay the taxes. And so it's interesting that, we often will sit down and we'll talk through someone's assets and they'll go, well, it's really simple. My son is really interested in the family home. Its value, it's about $2 million. And my daughter, you know what, she's already super established. And so I will just give her my RIF. It'll likely, by the time I pass away, it'll be about $2 million. And so, that's really simple. My son gets the home, he's happy, he's got $2 million. My daughter gets the cash, she's happy, she's got $2 million. But what actually happens behind the scenes, and when taxes get involved, is that your house, because you lived in it, assuming so, the entire time and didn't claim your exemption that you're allowed on any other property, goes untaxed. Whereas your RIF, $2 million, now hit 53% tax, and your estate is required to pay it. If the state has assets in it, such as the house, it is the one that has to pay the tax. So now we might be put in a position where the son is having to sell or mortgage the property just to pay the estate's taxes, while the daughter is off and running with the income from the RIF. Now, under a perfect circumstances, they could work it out and we could get the taxes covered. But the daughter may also just say, no, mom left me the full $2 million. That's what she wanted. Right. And so if we don't understand how our assets are taxed at the end of life, it could mean that we're allocating values to our children that aren't as equal as we intended, and could end up causing problems into the future.
Yeah, those are all great points. People don't realize there are different tax implications for different assets. So
an asset isn't just an asset.
Yeah.
Right?
Yeah. Fantastic advice. Okay, Tiffany. for you, how can investment strategy be structured to reflect the kind of legacy a woman wants to leave, not just financially, but in terms of value and impact?
Thanks, Sue. So there's lots of different strategies based on what your particular values are. So it can be done within your investment. So for example, do these companies participate in the UN sustainability goals? Are they lowering their carbon footprint? Are they trying to move the needle and be more impactful and changing the world? What are their hiring processes? Is it women owned? There's definitely options out there for everyone depending upon their values. Are you using your investments to give charitably during your lifetime, or as a beneficiary, or within your will to continue that legacy in whatever you value for yourself, for your children, and all for future generations? There's lots of options to be able to invest as your values that'll match up with your values.
Great, thank you. So my takeaway is that legacy planning is about being more intentional and making sure your wealth aligns with your values and thinking more about the impact you want to have over time. So yeah, so if anyone has any questions, please feel free to type them in the chat. I just see one question there. So before we wrap up, we're going to go to the Q&A session. But before we wrap up, I'd like to ask each of you one final question. So the question is, if there is one step women should take sooner rather than later when it comes to estate or financial planning, what would it be? And we'll start with Rose.
It's really simple. Be aware. And I think that when we have a life change, that is when we really realize how much we didn't know. And that can be a very unstable time. And now grasping for information is just catastrophic. And it can be as simple as, oh my gosh, I don't know my BC Hydro account number. I don't know how to pay the bill. And it's not because you don't know you have to pay BC Hydro. It's because all of these little details are all of a sudden either in your partner's name, or they were on auto pay, or things were sent to an email account that you can no longer access. So consolidating information is game changing. And for anybody who would like it, I have what I lovingly call my death folder checklist. And I know that name has no veneer on it, but if it's urgent, everybody knows it's relevant. And I encourage everybody to prepare a folder, binder, whatever works for you, where all of the information you need if a key person in your life passes away or becomes incapable is there, and everything anybody would need if you had a major change. And that second part is really critical, because it ensures that if you have an incapacity or death event, the people around you who are supposed to provide for your high continued quality of life have the tools. And just as importantly, and we don't always think of it in this context, if you're going to be switching accountants, moving to a new financial investment firm, or have a family law change, this is all information you need. And it can become a real deterrent to taking those steps if trying to gather all of this at the last minute just becomes too much of a burden. And I don't want to deter anybody from doing this kind of lovely death folder, but most of my clients take 6 months to a year to do it, because if you just sit down and you try and noodle through it, frankly, the feedback has been that it will crush your soul. So that's what lawyers are for. We appreciate that. But more practically speaking, if you just start a pile, and every month when your bills come in or it's tax season and there's stuff you need to add, you can do it in a more organic way, and it's not quite so awful.
Great, thank you. That's great advice. Okay, Nicole.
Do you want to just come back to that question one more time for me?
Sure. Well, we do have, let's just move on to the Q&A, because we do have a couple of questions, and we have about 12 minutes left. So why don't we start there? There's a question from Manissa, and I think, Rose, you're probably the most appropriate one to answer this question. Does anyone on the panel have advice for women who never marry, don't have kids, and would like to leave a legacy to charitable organizations?
First thing I will say is just because we don't marry doesn't mean we have spouses. So when you're doing your estate planning, when you're doing your legacy vision, watch out for that and have a conversation with your team if there's somebody who might actually have claims to this and that would impair your ability to achieve the plan that you want. When it comes to preparing these structures, there are lots of tools. And I don't want to sound like I have nothing but irritation for our tax regime, because it's really not that bad. But as Nicole was describing earlier, there is to some extent a singles tax in the way our system operates. If there are two people in the family unit who are spouses who are earning the same aggregated income that you as one individual are earning, that couple can pay less tax on that total amount than you as an individual will pay, simply because all of yours is captured under one set of marginal tax rates. And so when you're looking at how to create your legacy, you want to look at different ways that the income you earn is taxed, because some will push more of it outside your scope and into the tax system. And that's where you really want to sit down with someone like Tiffany so that they can create for you an investment plan that keeps the most in your pocket. But once you've got that, there's lots of ways to actually leave this to things that are important for you from a legacy perspective. One of them is to use your beneficiary designations. And as Nicole had touched on earlier, more often than not, when you designate somebody or some entity as the beneficiary on something like a RIF, a TFSA, a life insurance product, when you pass away, it will automatically go to that organization. There are some nuances that are developing around this, in that there's been some case law where the courts have actually tried to suck those funds back into the estate, but you can generally plan around that and make it really clear that that's not what's supposed to happen. You can also designate the beneficiaries through the form of your will or whatever trust you've set up. But for a lot of us, I think one of the things that becomes a hindrance to putting this to paper is that the charities and organizations that are important to us change over time. And particularly when you're looking at something like Indigenous groups and STEM, where how we view these things and sort of the community engagement with them has changed rapidly in a very short period, almost entirely for the positive. And so one of the things that people may want to explore is looking at what's called donor advised funds. The concept behind these is that there's one sort of umbrella charity. And within that charity, you can create your own little fund, the donor advised fund, which we often call a DAF. We love our little acronyms, it makes us feel cool. And within that DAF, year over year or month to month, you can meet with your advisors within that larger umbrella charity, and they'll help you steward that individual DAF and pick the organizations that are important to you. So if you wanted to see part of it to go to a university to set up a STEM scholarship, that can typically be done. If you wanted to see part of it go to an organization that funded Indigenous run businesses, you can typically pick that. So it's a really flexible way to incorporate that in your planning that gives you a long runway out of what you set up.
Great, thanks, Rose. Tiffany or Nicole, anything to add there? Okay.
I like the idea of the DAF. I think that there's I would say a lot of my clients that come to me and start talking about their charitable giving at end of life, they're not aware of that. And so I often say, have a look into it, because in a lot of cases, it gives you the flexibility that you need, but allows you to actually take the donation credits now. And where we don't need to use them, we can carry them forward over a number of years. And so we want to make sure that we get in front of that plan and time that donation so that we can use it as best that we can tax-wise as well. And that's not the most important piece of making the donation. Obviously, you're doing it for charitable purposes, but where you can have that consultation ahead of time, whether it be for a DAF or for an end-of-life donation, it's key to understand, okay, how does this help my taxes, and how could I either do it better, or are there any concerns with making that larger donation today versus later?
Great, thank you. So the next question we have from our friend Mary Lou. Hi, Mary Lou. So her question is, should clients move to make their investment accounts and principal residence joint with their offspring, even if they aren't in a blended family situation or a spouse has passed? So Nicole, maybe I'll ask you to weigh in on here, and then maybe Tiffany afterwards.
Yeah, so just adding individuals to avoid or to help with transfers or ease of access, I think we have to understand why we're adding the individual and what it will mean once they're added. And so oftentimes we do need our children to step in to help us manage our finances. And so we'll say, okay, well, if you want to add them on the account, let's establish why and what the purpose is. If I only have one child, my spouse has passed away, well, then it's likely that they are intended to receive the assets in the future. And so adding them to my bank account, not such a big deal. There's no tax impact at that point. Adding them to my investment account, however, could mean that I've just disposed of my assets or at least half of my assets when I've added them. And so we need to be very careful on a tax basis to understand what it means when we add that name. The other piece of the puzzle is when it comes to our death. If we added someone purely to help facilitate managing the accounts and it was established under what we would call a bare trust, whether it's a documented bare trust or it was an intended bare trust, we could fall under one, additional reporting rules, which is the bare trust itself needing to be filed. CRA right now is still determining what that looks like for us. But in often cases, it is truly just a bare trust. And so when we go to pass away and we have this asset that is now only in our son's name, but was intended to be my asset until for my lifetime and never their asset, technically it's a part of the estate. And so it starts to muddle the waters between what is an estate asset and what is an asset that was already gifted away in the past. So making sure that we're working with our lawyers and accountants to document and understand what is intended by adding the name, number one, and number two, if there's any tax consequences of adding an individual's name in the way that we are adding them.
Great, thank you. And Tiffany, do you have anything to add to that?
I would like to add that one thing that people should consider if they are needing assistance from their children to help pay expenses or for them to be aware of what's going on is to consider a power of attorney. That won't have any tax consequences. It doesn't change how the account works, but it does allow their child to be involved, to pay those expenses, to understand what's going on, to assist their parents.
Great, thank you. That's a really good point as well.
I think I'm just going to add one more point.
Sure.
Is that oftentimes it's the word probate. I'm going to have to pay probate. If I don't have someone on my accounts, I'm going to have to pay probate.
Yes.
And it's a scary word. In BC, it's 1.4%. So it can add up over your assets. But if you're just trying to avoid probate, we just need to identify how to do it properly so we don't incur these taxes otherwise or incur assets that are falling outside of your estate.
Yeah, good point as well. Okay, so I'm going to consolidate these next three questions to Rose. So from Dorothy, she needs to make changes to her will, or the question is, does she need to make changes to her will if major assets are increased? And she's also asking if someone on the panel can help her with a will. That would be Rose. And then Nathalie is asking for women with no kids and only a property, would you suggest a digital will?
Okay, a few things to unpack there, but we're going to keep it short and sweet because I know we're near end of time. First thing is never start with a digital will. And I say start there intentionally. You may ultimately migrate to that, but one of the things we always have to keep in mind is that technology will generate for us what we ask of it. And if we haven't had the conversations to know what to ask of it, it's generating a product that on the face of the information we gave it may work, but may be wildly unsuitable. So digital estate planning is never the right first step. And it's rare that in law we get to talk about absolutes, but I feel very confident in saying you should never start there. The second thing is when to update our plan. And I tend to think that it's less about the value of the assets per se and more about the nature of assets and our life events. And I tend to look at it under the category of matches, hatches, dispatches, and Americans. And we'll start with Americans because it's important to be very clear this has nothing to do with politics. As you've probably ascertained, I'm not a huge fan of everything Canadian tax, but I live in genuine fear and terror of the IRS. And the position on that has existed for decades. If you have somebody who is an American as a control person where there's economic control, so you've got them jointly on your bank account, you've made them an attorney under a power of attorney, a trustee, or an executor of a trust or a will, this means that all of your accounts that they can control by virtue of that must be reported to the IRS every year. And it's through a document called an FBAR. And failure to report comes with some very significant penalties. So if you've got anybody in those positions and they step into becoming American, that is a pivotal time to change it. And as a side note, the fact that that person is also Canadian or also a citizen of another country is irrelevant. Once you are American for the tax system, all of your other statuses do not obviate this requirement. Matches, it's really important to update your planning when there are new people that have come into your world that you want to provide for. It could be new spouses, it could be new generations you hadn't contemplated in your existing documents. And a bit unexpectedly, in my mind, that also captures situations where you have beneficiaries you have provided for and you're concerned about their spouses and their influence on their role in your estate plan. So it could be I've picked my daughter as the executor and her new husband has really changed who she is. And I do not think she's going to make the same decisions I was counting on her making. That could inform my estate plan. The same holds true. Let's say I'm leaving things to my son and it arises that he's in what I would consider to be a very abusive relationship. I might be worried that if I leave him his inheritance outright, it's going to be exploited. All of those are times for change. Then you have hatches. And that is typically a situation where new people are born, or we have an interesting combination of factors that change how we had planned for these people initially. So this person is born, another person becomes entitled to disability benefits. An individual just decides that they're not great at managing their assets, things like that. Then you've got dispatches. And this is where people have left your life or your assets have changed jurisdictions. So it could be that they've died. It could be that they've moved to somewhere that's remote, that's just not practical for them to do the roles I intended. Or it could be that I've acquired assets outside the province. And that's incredibly important to plan for because even if it's a small asset, if it's real estate, it could be worth $10,000, but the need to plan for it in all the jurisdictions makes a really big difference.
Great, thank you, Rose. So thank you, everyone. It's 11 o'clock now, so I'm going to have to wrap things up here, 11 o'clock in Vancouver. So thank you all for such a thoughtful discussion. I really appreciate the perspectives shared today. I hope it's given you a few useful insights and maybe sparked some ideas for your own planning, wealth, and legacy conversations. And for those of you whose questions we didn't get to, we'll do our best to have your questions answered directly by someone on our team. And I'd like to thank everyone for taking the time to join us today, both our valued clients and those of you who may be new to Genus. So a recording of today's webinar will be provided to you via email. It'll also be posted on our website in the next few days. And to our speakers, Rose, Nicole, and Tiffany, thank you so much for taking time out of your busy schedules to be with us today. And as a token of our appreciation, we've made donations on behalf of Nicole to the ALS Society of BC and on behalf of Rose to Battered Women's Support Services. So thank you both for the meaningful work that you support. And I'd also like to thank the team here at Genus, including Tiffany, who worked behind the scenes to produce these webinars. And our next webinar will be in April. Details will be announced at a later date, so we hope to see you at that time. And please stick around a few more minutes after we close the session. You'll be redirected to a survey, and we'd love to hear your thoughts and feedback. So enjoy the rest of the day. Thank you.